We would like to welcome you to the Stefanutti Stocks Financial Results webcast for the 6 months ended 31st August 2022. The presentation will be available on our website later today. I will be presenting an update of the restructuring plan and operational overview. Yolanda will then present the financials, after which I will then discuss industry-related matters and close with strategic objectives. There will be time at the end of the presentation for any questions. Restructuring plan update. The lenders have provided the group with funding of 1.2 billion, of which 45 million has since been repaid. The group is currently in negotiations with the lenders to extend the capital repayment profile of the loan, as well as its duration to February 2024 due to further delays beyond the group's control in resolving contractual claims and compensation events on certain projects, the slower than anticipated sale of identified operations, and the non-implementation of the materials handling and tailings management subdivision transaction. The benefit of the extended restructuring period provides a greater degree of confidence in anticipated cash flows, which will ultimately result in a reduction of the previously stated residual loan balance of 420 million. Interest on the loan is serviced on a monthly basis, and the group continues to evaluate an optimal business model and associated capital structure. The sale of non-core assets. During the period, 2 industrial properties were sold for a combined value of 33 million. The sale of certain operations. The transaction relating to the disposal of 49% of the entire issued share capital of the United Arab Emirates operation became unconditional on the 18th of July 2022. The group received an initial purchase consideration of 92 million on the 8th of November 2021. A further 11 million was received in May 2022. The balance of the purchase consideration is approximately 85 million, the majority of which is expected to be collected during the next financial year. Regarding the sale of the Mozambique operation, the requisite approval of shareholders was obtained on the 22nd of November 2022. Shareholders should note the implementation of the transaction remains subject to the fulfillment or waiver, if applicable, of certain remaining conditions precedent as set out in the circular. The group will update shareholders regarding the fulfillment or waiver of the remaining conditions precedent and the implementation of the transaction. Recovery of historical slow paying receivables. With respect to the outstanding amounts due by the Zambian government, the timing and quantum of receipts remains irregular. We anticipate collecting 48 million at current exchange rates. Plant sales from the beginning of the restructuring period to the end of August 2022, the sale of underutilized plant and equipment, including plant that has reached end of useful life, a total of 192 units have been sold with a sales value of 72 million and a net book value of 42 million, with 76 units remaining to be sold. The winding down of contract mining subdivision, a total of 151 units have been sold with a sales value of 237 million and a net book value of 197 million. 42 million of outstanding installment sales were settled. 10 units remain to be sold. Marine, a total of 6 units have been sold with a sales value of 5 million and a net book value of 461,000. 49 units remain to be sold. SSBR joint venture package 16 update. Construction is complete. There remains a small management team on site awaiting access and services from Eskom to conclude the critical commissioning activities that remain outstanding. It is anticipated that the commissioning and all contract documentation will be closed out in the new year. The agreement of measurement is substantially complete and should be concluded by the end of the financial year. Substantial variations remain outstanding and are still to be agreed with Eskom. The outcome of these will determine whether further certification will be secured. Should agreement not be reached, these variations will be referred to the Dispute Adjudication Board, DAB. Since August 2021, the group has managed to secure payments of a combined value of 110 million for measured work and DAB rulings. As previously mentioned, the parties entered into an interim arrangement for the purposes of agreeing or determining the contractor's claims and facilitating the dispute resolution process in February 2020, which involves the appointment of independent experts to evaluate the causes, duration, and quantification of the delays. Further to the above, the parties and the DAB have signed a memorandum of understanding where the DAB will issue decisions confirming the entitlements which the experts have agreed, which will be binding on the parties. The DAB will rely on the experts for the narrowing of the issues to be considered. The DAB will make interim decisions on the narrowed issues in a progressive manner, which will be binding on the parties. The DAB will issue such interim decisions for both time and money. At the end of the process, in respect of both time and money, the DAB will issue a final binding decision in terms of the contract, at which point either party may issue a notice of dissatisfaction and refer the dispute to arbitration. Claim 5 comprises all claims consequent upon events or circumstances giving rise to entitlement to an extension of time which occurred pre-December 2019. Both parties' independent delay experts have completed all analysis and submitted their final differences to the DAB for a decision on the delay entitlements. Meetings led by the DAB started in November 2021. Phase 1, access-related delays. The delay experts have reached agreement on 49,964 days delay. The final access determination will be signed off by the DAB following the completion of the Phase 2 process. Phase 2, construction-related delays. The delay experts have reached agreement on 23,208 days delay. A DAB decision on the remaining Phase 2 submissions is expected by the end of this month, following which the delay experts will issue a further joint agreement for both Phases 1 and 2. Phase 3, commissioning-related delays. The DAB will shortly be engaged to issue interim decisions on the differences between the delay experts. Taking the agreements reached to date, for Claim 5, agreed delays extend the completion date to September 2021, noting that the original contract completion date was November 2016. The independent quantum experts have completed the exercise of interrogating the total costs which have been incurred on the project. The interrogation was conducted on a sampling basis, and to date, no anomalies have been found. The quantum experts have agreed the methodology to apply the project costs to the delay entitlements and to quantify the financial consequences thereof. Although differences of principle are anticipated, the quantum experts are engaging on these principles and attempting to narrow issues for referral to the DAB for interim decisions. This quantum process is running in parallel with the delay process. To date, the JV has submitted its overarching preliminary and general cost claim and its overarching subcontract preliminary and general cost claim. The provisional value of these claims is 337 million and 194 million respectively, after taking into account all payments received to date. The quantum experts are currently reviewing the claims, drafting agreements, and narrowing issues of differences for referral to the DAB. Early in 2023, the DAB will be engaged to issue interim decisions on the differences between the quantum experts on the claims. The remaining 3 cost claims will be submitted to the quantum experts by the end of the year, being construction costs, commissioning costs, and interest and finance costs. The DAB has indicated that it anticipates issuing its final Claim 5 decision in the second quarter of 2023. Claim 6 comprises all claims consequent upon events or circumstances giving rise to entitlement to an extension of time which occurred post-December 2019. Claim 6 will be consolidated and submitted to the DAB for its decision as to the contractor's entitlement to extension of time and additional payment once Claim 5 has been concluded. None of these claims have been recognized in the financial statements. Stefanutti Stocks Izazi Joint Venture Package 28 Update. During June 2018, the JV commenced adjudication proceedings in relation to numerous compensation events which had not been assessed on the contract. In early 2019, Eskom terminated the contract for convenience due to their inability to provide access to complete the works. The JV submitted its final application in March 2019, after which the engineer issued 2 negative final payment certificates in August 2019 and April 2020, alleging overpayments. The alleged overpayments were for measured work and compensation events. This prompted the notification of many new disputes, which were then included in the adjudication process. Adjudication hearings were conducted during the months of November 2020 and February 2021. To resolve the measure dispute, the parties agreed to embark on an independent quantum expert process similar to Package 16. In order to accommodate this independent expert process, the adjudicator had been requested to not publish his decision until advised by the parties. During the reporting period, the parties reached agreement on measured works and formalized an extended process to agree the compensation events in a categorized manner. Once the extended process is complete, the intention is to request the adjudicator to release his decision, which will hopefully then conclude the balance of the matters that remained in dispute. The group is confident that an agreement can be reached on the compensation events and thereafter formalize a final account early in the new financial year. The group is confident that the final payment application is accurate and therefore no provision has been made. The group delivered an improved performance for continuing operations. The adjudication and awarded tenders, especially in the public sector, where tender cancellations are common and it can take up to 2 years for an award, continues to impact the group's performance through all regions and disciplines in the group. The focus of the group remains reducing the number of loss-making projects. For the reporting period, of the 158 active projects, 7 projects declared an aggregated operating loss of 19 million against an aggregated contract revenue of 130 million. 78% of the reported contract revenue was executed at better than tender margin, an improvement when compared against 59% at August 21 and 70% at February 2022. The group will continue to strive to achieve a minimum of tender margin on all projects. In line with the restructuring plan, the group has initiated a disposal program to sell certain operations, which have accordingly been classified as discontinued operations. Consequently, the results for this period and the comparative period have been prepared to reflect continuing and discontinued operations. I shall now cover the key indicators for continuing operations. There has been a decrease in contract revenue to 2.9 billion compared against a restated contract revenue of 3.2 billion in August 2021. The group is reporting an operating profit of 54 million compared against a restated operating profit of 9 million in August 2021. The group's order book at August 2022 was 6.6 billion when compared against 5.2 billion at August 2021. Other financial indicators will be covered by Yolanda. The group prides itself on its health and safety performance. There were no fatalities during the period. The group's lost time injury frequency rate and recordable case rate at August 2022 was 0 and 0.25 respectively. Management and staff remain committed to our health, safety and environmental policies and procedures, and together strive to constantly improve the group's health, safety and environmental performances. The group is a level 1 broad-based black economic empowerment contributor measured against the construction sector scorecard with a black economic interest score of 72.76%. Included in the results are the following abnormal and non-operational costs. Restructuring costs of 22 million and abnormal legal fees of 6 million. When excluding these amounts, normalized trading would have been an operating profit of 82 million at a 2.9% operating margin, an improvement from 2.7% in August 2021. Although the current liabilities have exceeded current assets over the past 4 reporting years, the group has successfully completed projects to the value of 31 billion. In the current period, when excluding the funding loan, current assets exceed current liabilities with 135 million. Due to lender group support, our operations are not hampered by working capital constraints, and lenders continue to provide guarantee support for current and future projects being undertaken by the group. The group has completed its internal restructuring initiatives. Mechanical electrical piping, MEP, from the beginning of the financial year forms part of Inland Region as indicated by the green shading. Even though MEP reports into the Inland Region, they operate in and support all regions. I shall now take you through the performance of the regions. With MEP now included in the Inland Region, the results for the prior period have been restated to reflect this. Inland Region's contract revenue is 1 billion compared to the 1.2 billion as restated for August 2021. This reduction in revenue is attributable to the mechanical and piping disciplines having slow starts to the year due to late awards and delayed contract starts. With an operating profit of 37 million compared against a restated operating profit of 6 million in August 2021. 88% of this region's contract revenue was executed at better than tender margin. The civils and roads and earthworks disciplines are profitable and performing to expectation. The non-implementation of the materials handling and tailings management subdivision transaction, as mentioned previously, continues to negatively impact the results of these disciplines. The contract mining subdivision was wound down in October 2021 and is disclosed as part of discontinued operations. Update on historical projects. The contract mining project, which the group terminated, is proceeding to arbitration and will be completed in the next financial year. The group is confident that the termination was lawful and therefore no provision has been made. The cancelled petrochemical contract arbitration had to be postponed due to a fundamental change in the client's defence. A date for the arbitration is yet to be set. At this stage, the financial impact thereof cannot be quantified, therefore no provision has been made. With respect to the mechanical project which the group terminated, the arbitration remains ongoing and is expected to be completed early in the new financial year. The group is confident that the termination was lawful and therefore no provision has been made. Coastal Region's contract revenue is 650 million compared to 491 million for August 2021, with an operating profit of 1 million compared against an operating loss of 2 million in August 2021. This region's revenue and profitability were negatively impacted by the devastating floods, late awards and delayed contract starts. 54% of this region's revenue was executed at better than tender margin. Western Cape Region's contract revenue is 306 million compared to the 677 million at August 2021, with an operating profit of 15 million compared against 22 million in August 2021. This region's year-on-year reduction in contract revenue and operating profit was due to late awards and delayed contract starts. 91% of this region's contract revenue was executed at better than tender margin. Africa region performed well, reporting contract revenue of 875 million compared to 744 million in August 2021, with an improved operating profit of 60 million compared against 42 million in August 2021. Eswatini and Zambian operations reported good results, with Botswana performing as expected. 78% of this region's contract revenue was executed at better than tender margin. Inland Region's order book at September 2022 was 3.3 billion, Opportunities exist for this region in transport infrastructure, mine infrastructure, renewable energy, industrial plants, oil and gas, and geotechnical. In the short term, there are potential awards to the value of approximately 2.6 billion and future opportunities to the value of approximately 15 billion have been identified. Coastal Region's order book at September 2022 was 1.4 billion. Opportunities exist for this region in transport infrastructure, water and wastewater treatment plants, and in the private sector, commercial, retail, and industrial projects. In the short term, there are potential awards to the value of approximately 1.8 billion and future opportunities to the value of approximately 19 billion have been identified. Western Cape's order book at September 2022 was 838 million. Opportunities exist for this region in water and wastewater treatment plants, transport infrastructure, framework agreements, and in the private sector, commercial, residential, retail, industrial plants, warehouses, and data centers. In the short term, there are potential awards to the value of approximately 550 million and future opportunities to the value of approximately 10 billion have been identified. Africa Region's order book at September 2022 was 851 million. Opportunities exist for this region in mine infrastructure, transport infrastructure, water and wastewater treatment plants, pipelines, dams, strategic fuel farms, and in the private sector, commercial, retail, office, leisure, warehouses, renewable energy, and industrial projects. In the short term, there are potential awards to the value of approximately 570 million and future opportunities to the value of approximately 25 billion have been identified. The group's order book at September 2022 was 6.3 billion. In the short term, there are potential awards to the value of approximately 5.5 billion and future opportunities to the value of approximately 69 billion have been identified. Guidance for continuing operations for the next 6 months. Inland region, we expect contract revenue to increase with an improved operating profit margin. Coastal region, we expect a significant increase in contract revenue with an improved operating profit. Western Cape region, we expect contract revenue to increase with a reduced operating profit margin typical of a building operation. Africa region, we expect a slight reduction in contract revenue with a reduced operating profit margin. Head office will continue to incur abnormal costs relating to the restructuring plan, comprising advisory, legal, and funding fees. We expect similar costs as currently reported. I would now like to hand over to Yolanda.
Thank you, Russell. The group reports satisfactory results due to an improvement from operations and a significant reduction of loss-making contracts. In line with the restructuring plan, the group has initiated a disposal program to sell certain operations, which have accordingly been classified as discontinued operations. These disposals are expected to be concluded within the next 12 months. Consequently, the results of the comparative periods have been restated to reflect continuing and discontinued operations in accordance with international financial reporting standards. Going concern. The directors consider it appropriate that the group's results for the period be prepared on the going concern basis, taking the following into consideration. The current order book. Imminent project awards. Continuing operations executing the group's order book profitably. The availability of short and mid-term projects. Reaching a favorable outcome on contractual claims and compensation events on certain projects. A successful completion of current negotiations with the lenders relating to the extension of the loan and capital repayments to February 2024. Continued support from the lenders and successfully implementing the restructuring plan. The funding provided by the lenders has assisted in relieving the group's liquidity pressures, even though total liabilities continue to exceed total assets at 31st August 2022, representing technical insolvency. However, the group believes it remains commercially solvent based on the cash flow projections included in the restructuring plan and the continued support provided by the lenders. In addition thereto, uncertainty surrounding the contingent liabilities as stated in Note 26 of the Group's consolidated annual financial statements for the year ended 28 February 2022 continue to indicate that a material uncertainty exists that may cast doubt on the Group's ability to continue as a going concern in the short term. Looking at the statement of profit and loss, with respect to continuing operations, contract revenue reduced from 3.2 billion restated to 2.9 billion due to a late start of contracts in the mechanical discipline and a delay in awards in the Western Cape region. The operating profit for continuing operations is 54 million with an improved margin of 1.9% compared to 0.3% of the prior period. Included within operating profit are restructuring costs and abnormal legal fees of 28 million. Excluding restructuring costs and abnormal legal fees, the operating profit would have been 82 million. Net finance costs consists of interest earned of 5 million and interest paid of 60 million. Included within interest paid is interest on the funding loan of 53 million for the period. The tax charge has been impacted by the profitability of the cross-border operations, as well as the Group not providing deferred tax on the losses incurred relating to the South African trading entity. Loss for the period from continuing operations is 34 million, mostly impacted by restructuring and abnormal costs, as well as interest paid. With respect to discontinued operations, the discontinued operations reported a profit of 43 million, predominantly comprising the realization of a foreign exchange gain of 71 million, included within reserves, which has been reclassified to profit or loss, relating to the disposal of Altair stocks, which became unconditional on the 18th of July 2022, and a fair value adjustment of 28 million relating to the imminent sale of Mozambique. The Group reports a profit for total operations of 9 million, compared to the loss of 188 million for August 2021. Moving on to the statement of financial position. Other current assets increased from 2.4 billion to 2.8 billion due to the following. Contracts in progress increasing by 75 million to 814 million due to the late certifications on 2 projects subsequently invoiced. A 24% increase in trade accounts receivable despite a decrease in trading activity, resulting in an increase in debtors days from 58 days to 75 days. The increase predominantly relates to outstanding amounts on 2 projects which have subsequently been paid, and other receivables increasing due to the recognition of the final purchase consideration of approximately 85 million on the disposal of Altair stocks. Non-current assets held for sale and disposal groups of 598 million predominantly comprises the assets relating to the Mozambique operation. Moving to the liability side of the statement of financial position. Total interest-bearing liabilities have decreased slightly from 1.45 billion at February 2022 to 1.4 billion. The Group is currently in negotiations with the lenders to extend the capital repayment profile of the loan as well as its duration to February 2024. The Group envisages to service the funding loan from proceeds of the Mozambique sale transaction, the sale of non-core assets, and the favourable outcome from processes relating to the contractual claims and compensation events on certain projects. Trade and other payables have decreased from 1.5 billion to 1.3 billion due to the decrease in trading activity. Excess billings over work done has in total increased by 393 million to 1.3 billion, relating to advances received on recently awarded projects. Of these advances, 212 million is expected to be utilized during the second half of the next financial year. There has been an increase in total provisions from 598 million at February 2022 to 700 million due to specific project requirements. Liabilities associated with the Mozambique operation amount to 258 million. Moving on to the statement of cash flows. The cash flow statement is presented for total operations. The operations generated 155 million compared to the 12 million consumed for the 12 months to February 2022. An increase in other current assets, excess billings over work done, and a reduction in trade and other payables contributed towards working capital of 30 million, whereas 241 million was consumed for the prior year. Total tax paid of 50 million comprises 36 million foreign taxes relating to Eswatini and Zambia, and 14 million of withholding taxes. Other investing activities includes a receipt of 11 million for Altair stocks and 23 million for the disposal of plant and equipment. Financing activities reflects a reduction in total debt of 56 million. The group's overall cash position has increased to 456 million from 409 million. In conclusion, from my side, successfully implementing the restructuring plan and focusing on reaching a favorable outcome on contractual claims and compensation events on certain projects remain a priority. I will now hand back to Russell to close the presentation.
Thank you, Yolanda. We will now cover industry-related matters. The group continues to be negatively affected through disruptive and unlawful activities by certain communities and informal business forums in certain parts of South Africa. There is currently a lack of public sector infrastructure spend. Over the past 5 years, revenue generated by the group from public sector work has reduced by 50%. Sunroll recently awarded 4 contracts valued at 10.6 billion, which had previously been cancelled. 9.5 billion was awarded to joint ventures with foreign contractors. Concerns have been raised with respect to compliance and procedural irregularities on some of these awards. The group bid one of the projects and has made a prior request to Sunroll, as they are a public body, requesting access to the written or oral records of its bid evaluation report and adjudication of the contract, which resulted in its decision to award. If compliance and procedural processes are flouted, this poses a significant risk to the South African construction industry as a whole. To conclude our presentation, our focus is on the successful completion of the outstanding items in our restructuring plan, achieving favorable outcomes from claims and compensation events on Kusile and the other projects, the collection of all outstanding slow paying receivables, and continue our focus on the reduction of loss-making projects and maintaining profitability. This brings us to the end of our presentation. We are now available to respond to any questions that you may have. Thank you.